The 10-year Treasury yield dropping from that 5% mark. It surpassed that level for the first time since 2007 on Thursday. Now, according to Mitsuho's Peter Chatwell, that's a psychological level as much as anything else. Even so, elevated yields don't tend to be great news for growth stocks. And with tech earnings hitting this week, there's lots to digest. On the rising yield environment, our next guest says for investors, quote, seeking both yield and safety, this presents an attractive alternative to the stock market. Well, joining me now, Anthony Saccaro, Providence Financial Insurance Services President. Thank you so much for joining me today. So give us this lay of the land. People want to play it safe. Usually that would be bonds. Is that still the way, and considering how much potential upside there still is?
Well, that's the issue, is the bond market and the rising yields now are giving the stock market direct competition. There's this battle going on between the stock market and the bond market. You know, the stock market or the bond market is clearly telling us that the economy is strong and everything is is going to be great going forward. The inverted yield curve has become less inverted. There's been a steepening of the yield curve, so less likely potential for recession. But the stock market is giving us some mixed signals. The earnings reports over the last couple of quarters haven't been great. We're hoping that Q3 increases and Q4. That's what the market is looking for. But you look at the labor market, still very strong. You also look at GDP and you look at inflation, and that's going to stay elevated. And that's not potentially going to be good for the stock market. And the bond market, that 5% yield is a direct competitor of the stock market now. But because it looks like a recession might be less likely, investors in stocks are demanding a higher yield in bonds. But if you're close to retirement or you're going to need that money soon, I mean, I really think you probably should think about locking in some longer term yields at this point. That's something you haven't been able to do for a long time.
It's true. And Anthony, a lot of people are wondering then, where are the safe havens then? Since there is still some uncertainty, potentially the Fed signaling it could raise rates again in December, saying that's not off the table. What do the current safe havens look like in this environment?
Well, certainly fixed income is, in my opinion, a safe haven because the income is the one thing that you can count on. There's so much up in the air right now. There's not a shortage of things to look at across the world that could cause the stock market to tumble. And we've had that before, right? We had the tech crash no one expected. We had the financial crisis that at that moment no one expected. The stock market tends to do the opposite of what you think it's going to do. And when people are feeling strong about things, when people are feeling good about things, the stock market tends to do the opposite. So it's not time to let your guard down. What we tend to focus on for our clients at Providence Financial is we focus on income, because if you're invested in a high quality portfolio of fixed income investments or even stocks that yield 3 or 4% in a highly diversified portfolio like we're getting for our clients, the one thing you can count on over the next 10 years is income. And I want to know that no matter how you're invested, you have something you can count on. I don't think you can count on share price right now, but income and dividends you can count on.
And so in terms of the fixed income that you like, I mean, we saw some commentary from Bill Ackman, covering his short in this, and people are trying to really assess whether they should be looking at the longest term yields. Which ones do you think are most attractive, especially since we don't know what's going to happen with oil prices and the hostilities in the Middle East, what's going to happen with China and these other things that's also affecting inflation, some of these stickier parts of PCE?
So I think it depends on what stage of life you're in. I think if you have 10 or more years until you're retired, fixed income absolutely should be a part of your portfolio for two reasons. One, yields are higher. You can lock in 10-year yields right now at close to 5%. We've seen that 10-year yield fluctuate all morning, and right now I think it's just shy of 5%. But if you can get 5% guaranteed for 10 years, that's a phenomenal, that's very attractive. The other second reason for locking in maybe 10-year yields at this point is we know at some point the Federal Reserve is going to lower interest rates. Now, part of the reason why the stock market has done well this year is because that's been pushed out. We think that, initially it was 2024 they were going to lower rates. That may happen and may go longer than that. But the fact is that when the stock market starts to falter and the economy starts to falter, the labor market starts to falter, Federal Reserve is going to lower rates, and that's going to allow those of you that have bonds to have an increase in the bonds. So for the first time in decades, you can buy bonds as a capital appreciation play. So lock in high yields, get capital appreciation. That's the bond market for the younger investors. Other than that, keep going in stocks. For older investors, you want to shift to a higher percentage of bonds because you can't afford to take take the risk if you're going to be retiring soon. And if you're already retired and living off your income, please don't be selling shares of your mutual funds and stocks to get your income. Yields are high enough you can live off the incomes without cannibalizing your principal. It's a great time to lock in some income if you're retired.
And what do you think could throw the biggest wrench in that base case in terms of the risks ahead?
Well, the labor market, I think, is a big factor. That's certainly one. And the labor market generally shifts pretty quickly. Right now, the labor market's strong. I still think there's 1.7 or 1.8 workers available for every job. That in historical has been shown to shift very quickly. And the labor market comes before a recession. The weakening of the labor market is going to happen before a recession. That's something that could throw the stock market into a tailspin. The other thing that could throw the stock market into the tailspin is everything that's going on geopolitically. I'm actually surprised that this war hasn't caused a tailspin in the market already. When you look at Israel, Israel has, I think they're the fourth largest country, or the country with the fourth largest holdings in the NASDAQ, and that has no small part in the S&P 500 and the Dow Jones. So I'm surprised that the market has been so resilient as it is. But at some point in time, something there could turn as well, especially if we have a terrorist attack on our own country. There's a lot of things out there that could cause the stock market to pop.
Indeed, a lot of us keeping track of all of this. And it's interesting, one of our other guests also talked about perhaps a potential desensitizing of markets to a lot of these things, having sort of been very war-worn down by what we've seen with Russia and Ukraine. Appreciate your insights. Anthony Saccaro, Providence Financial Insurance Services President. Thank you for joining me.